Hi, this is David Hardesty, and in this lecture we discuss the special rules for the taxation of U.S.-owned foreign corporations and their owners, primarily the rules for controlled foreign corporations, but also the GILTI rules and the rules for the deduction of dividends from specified 10% owned foreign corporations. The objectives of this lecture are as follows. To understand the definition of a controlled foreign corporation, or CFC, understand the U.S. taxation of CFCs, understand the U.S. taxation of CFC owners, understand the meaning of Subpart F income, understand when tangible personal property sales are Subpart F income, understand when sales of services are Subpart F income, understand the basics of the GILTI rules and their relationship to the CFC rules, and understand the special deduction for dividends from specified 10% owned foreign corporations. First, the definition of a CFC. A controlled foreign corporation, or CFC, is an entity treated as a corporation for U.S. tax purposes. Organized or incorporated in a foreign country, where more than 50% of either the total voting power of all classes of stock entitled to vote, or the total value of all stock in the corporation is owned by U.S. shareholders on any day during the taxable year. For purposes of stock ownership testing, only U.S. shareholders owning at least 10% of the voting stock or 10% of the value of all shares are counted. Here's an example of the application of the CFC definition. Foreign Co. is a foreign corporation organized in country X. Jones owns 50% of the stock of Foreign Co. Smith owns 1% of the stock. Both Jones and Smith are U.S. citizens. Foreign shareholders own the remaining 49% of the company stock. Smith does not own at least 10% of the stock. Therefore, for purposes of meeting the definition of a CFC, Smith is not considered a U.S. shareholder, even though he is a U.S. citizen. Therefore, Smith's stock is not counted for purposes of the ownership test, and Foreign Co. does not meet the definition of a CFC. Now let's turn to the U.S. taxation of the CFC. No special rules apply to the direct U.S. taxation of the CFC. The rules discussed in Lecture 12-1, applicable to all foreign corporations, apply in full to CFCs. Here's a recap of those rules. Where the CFC is organized in a non-treaty country, it is taxed in the United States on its business profits to the extent those profits are effectively connected with the conduct of a U.S. trade or business. With regard to a CFC that is organized in a treaty country, its U.S. tax on business profits is limited to the tax on such profits that are attributable to a permanent establishment in the United States. With regard to non-business income, for example, royalties, the CFC is taxable in the U.S. On U.S. source non-business income unless the taxation is limited by treaty. Where the rules for CFCs differ from those applicable to other foreign corporations is the taxation of shareholders. When a corporation is a CFC, then its shareholders are taxed directly on certain income of the CFC. The income so taxed is the corporation's Subpart F income. We will discuss the definition of this income in the remaining slides. Any income not previously taxed which has been repatriated to the United States. Repatriation can take the form of dividends to shareholders, loans to shareholders, and certain investment in U.S. assets. What is a Subpart F income? Subpart F income includes foreign-based company sales income, foreign-based company services income, certain other income not discussed here. Subpart F income generally does not include any income upon which the CFC itself has been directly taxed by the United States. Therefore, there was ordinarily no potential for double taxation of the same income. Income that would otherwise qualify as Subpart F income is either taxed directly to the corporation or taxed directly to the shareholders, but not both. Let's talk about foreign-based company sales income. Foreign-based company sales income, or FBC sales income, is income resulting from one of the following 4 transactions engaged in by a CFC. In this slide, we're going to use the following abbreviations to show these transactions. P is purchase, S is sale, PP is personal property, RP is related person, and AP is any person. The first type of transaction that can create FBC sales income is the purchase of personal property from a related person and its sale to any other person. The second is purchase of personal property from any person and its sale to a related person. The third is sale of personal property to any person on behalf of a related person. And the fourth is purchase of personal property from any person on behalf of a related person. There are 2 more conditions before there is FBC sales income. These 4 transactions will result in FBC sales income only if the first is property is manufactured, produced, grown, or extracted outside the country under whose laws the CFC is created or organized. The sale of property produced in the CFC's country, for example, does not generally result in FBC sales income. The second is property is sold for use, consumption, or disposition outside such foreign country. Sales to buyers in the CFC's country of incorporation generally do not result in FBC sales income. Here is an example of FBC sales income. Foreign Co. is a country X corporation that earns revenues from the sale of clothing from its website. Foreign Co. is wholly owned by US Co., a US corporation. The clothing sold by Foreign Co. is purchased from US Co. The clothing is not manufactured in country X. The clothing is shipped directly by US Co. to customers of Foreign Co. all of Foreign Co.'s customers are located outside of country X. Foreign Co. earns a net profit of 20% on sales. It pays no tax in country X. This series of transactions is characterized as follows. The clothing, which is personal property, was purchased from a related party outside of country X, and the clothing was sold to persons outside country X. These sales meet all of the requirements for FBC sales income. Accordingly, the income is Subpart F income and is taxed directly to U.S. Co., unless certain exclusions apply, the most important of which are the de minimis exclusion and the high foreign tax exclusion. FBC sales income requires, among other things, the purchase of personal property from a related party. What happens if there is a license of property instead of a purchase? A license of intangible personal property, for example, a copyright on digital property, is not the same as a purchase. Accordingly, if a CFC licenses from a related party the rights to reproduce and sell personal property, including, for example, digital property, and then sells that property, FBC sales income should not result. However, even if there is no FBC sales income, the GILTI rules discussed later can have the effect of taxing U.S. shareholders on that income when it is not Subpart F income. Here's an example of the license of intangible property from a related person used to produce other property. Foreign Co., a country X corporation, is a CFC that is 100% owned by Domestic Co. In 2021, it licenses the copyright to software X from Domestic Co. and receives a copy of that software. It sells copies of the software as digital property via download from its country X web server to customers outside of country X. While the copyright is personal property and the digital software is personal property, there is no purchase of the software or the copyright, so the FBC sales rule should not apply. However, the resulting income can be taxable to Domestic Co. under the GILTI rules if they are not taxable under the CFC rules. If the property purchased or sold is digital or intangible property, do the CFC rules apply? Both intangible property and digital property can properly be termed personal property since they are not real property. Nominally, the CFC rules should apply. However, the CFC rules have traditionally applied to goods, not digital or intangible personal property. The regulations make a number of references to goods. In addition, the term personal property is not defined for purposes of the CFC rules, so applicability of the CFC rules to transactions involving intangibles and digital products is unclear. However, the uncertainty surrounding the application of the rules to intangibles and digital property sales is rendered somewhat moot by the GILTI rules discussed later, which tax U.S. shareholders on the income of a CFC that is not Subpart F income. Here's an example of applying the CFC rules to intangibles and digital property. Foreign Co., a country X corporation, is a CFC that is 100% owned by Domestic Co. In 2021, it purchases the copyright to movie X from Domestic Co. along with a copy of that movie. It sells copies of the movie as digital property via download from its Country X web server to customers outside of Country X. While the copyright is personal property and the digital movie is personal property, it is not clear if the CFC rules apply to either type of property to create foreign-based company sales income. However, the resulting income can be taxable to Domestico under the GILTI rules if they are not taxable under the CFC rules. Let's discuss Fbc Services Income. Certain services result in Fbc Services Income, which is a type of Subpart F income. Here are the elements of Fbc Services Income. 4 transactions generate Fbc Services Income. The CFC is paid for the services by a related person. The CFC performs services that a related person is or has been obligated to perform. The CFC performs services with respect to property sold by a related person, and the performance of such services constitutes a condition or material term of the sale, or a related person provides to the CFC substantial assistance in the performance of such services. A CFC does not have Fbc Services Income unless the services are performed outside the CFC's country of incorporation. Services are performed where the CFC's employees are physically located when they perform the services. Here's an example of Fbc Services Income. Ford & Co. is a Country X corporation organized to perform certain online services. Ford & Co. is owned by USCO, a U.S. corporation. USCO sells computer software. The software comes with a service contract that entitles customers to receive technical support. The technical support is delivered by Ford & Co. Most of the assistance is through the Ford & Co. website, but some of the assistance is delivered by live technicians employed by Ford & Co. All of the Ford & Co.'s activities take place in country Y, and its web server is located in country Y. Recall that Ford & Co. is organized in country X. USCO pays Ford & Co. a fee for this work. Ford & Co. earns a net profit of 20%. Here's an analysis of this fact situation. Ford & Co. is paid for services by a related person, and the services are rendered outside Ford & Co.'s country of incorporation. Therefore, net profit earned by Ford & Co. is Fbc Services Income. If we change the facts so that all of Ford & Co.'s activities take place in country X, then there is no Fbc Services Income because the requirement to perform the services outside the country of incorporation is not met. CFCs engaged in numerous types of cloud transactions that could potentially result in Fbc Services Income, such as providing online services to a related company. There is no specific guidance on whether cloud transactions might result in Fbc Services Income, but here are some things to consider. A CFC can provide cloud services to a related company or to a related company's customer, including online access to the CFC software, online order processing services performed by the CFC, or online data analysis performed by the CFC. If cloud-based services are delivered using the CFC personnel and equipment inside its country of incorporation, does Fbc Services Income result? Probably not. If the cloud-based services are delivered using the CFC personnel and equipment from outside its country of incorporation, does Fbc Services Income result? The answer is probably yes, but it is not certain. Here's an example of cloud-based services where in some circumstances there is no Fbc Services Income, and in some circumstances there might be Fbc Services Income. Domestic Co., a U.S. corporation, wholly owns Foreign Co., a Country X corporation. Foreign Co. provides online software development platform and website hosting to unrelated end users from its Country X web server. Such cloud transactions should be classified as services. Because there are no related parties involved, there is no Fbc Services Income. Even if there were related parties involved, there would be no such income since all of the activities are performed in the country of incorporation. Only if related parties are involved and a portion of the Foreign Co. activities take place outside of Country X would there be a possibility of foreign-based company services income. Let's discuss briefly the inclusion of income for earnings of the CFC invested in U.S. property. A U.S. shareholder of a CFC includes in taxable income the earnings of the CFC that are invested in U.S. property. This amount is limited to the current and accumulated earnings of the CFC. This treatment of U.S. investments is similar to that of the distribution of a cash dividend by the CFC. Here's an example of an increase in U.S. investments. Foreign Co. is a CFC organized in Country X on January 1st, 2021, and owned 100% by U.S. taxpayers. During 2021, it has earnings of $250 and has no Subpart F income and pays no dividends. However, it invests $150 of its earnings in U.S. property. This investment is treated as a deemed distribution to CFC's shareholders and is taxable to the extent of current and accumulated earnings. Let's discuss the deduction for dividends received from a specified 10% owned foreign corporation. Section 245A provides a U.S. corporation, not an individual, with a deduction for the foreign source portion of dividends received by domestic corporations from specified 10% owned foreign corporations. The net effect is to make foreign earnings permanently tax-free in the United States as long as they are distributed as dividends to U.S. corporations that are 10% shareholders. Foreign earnings of a CFC that are not distributed remain subject to the direct taxation under the CFC rules. Here are the requirements for the Section 245A deduction. First is the dividend must be from a specified 10% owned foreign corporation. The shareholder recipient must be a U.S. domestic corporation. The shareholder recipient must be a U.S. shareholder with respect to such foreign corporation, that is, it must own at least 10% of the stock. The stock holding period requirements must be met. And the corporate deduction is limited to the foreign source portion of the dividend. Here's an example of Section 245 from the text. Domestic Co., a U.S. domestic corporation, wholly owns Foreign Co., a specified 10% owned foreign corporation. At the beginning of 2021, Foreign Co. has no accumulated earnings and profits. Foreign Co. has 100x of current year earnings and profits for 2021, of which 25x is attributable to effectively connected income. Foreign Co. makes a distribution of 150x to Domestic Co. in 2021. The amount of this distribution that is a dividend is limited to 100x, the 2021 earnings and profits. Of the 100x, 75x is foreign source income. The amount of the dividend eligible for the 245A deduction is then 75x. Our final topic is the GILTI rules, which stands for Global Intangibles Low Taxed Income. We're only going to highlight the key aspects of the rules. See the text for a full explanation. The GILTI rules provided by Section 951A require a U.S. shareholder of a CFC to include in income a calculated amount of GILTI. The amount equals the gross income of certain CFCs owned by the shareholder, less any subpart F income included in that gross income, excluding certain types of CFC gross income, less deductions allocable to that income, and less 10% of the adjusted basis of the tangible assets of such CFCs. A corporate shareholder, not an individual, can take a deduction under Section 250A of up to 50% of the amount of GILTI. Here's a simplified example of GILTI, which does not take into account a number of factors that complicate the calculation, such as foreign taxes paid by the CFC, the presence of income that is effectively connected, the presence of subpart F income, Section 78, or the ownership of multiple CFCs. Domestic Co. is a U.S. corporation, and Foreign Co. is a Country X corporation. Domestic Co. owns 100% of Foreign Co., making it a CFC. Foreign Co. earns $1,000 of net foreign source income from providing online services. Foreign Co. has no subpart F income, pays no foreign taxes, and has no tangible assets. Foreign Co.'s GILTI is assumed to be $1,000, which Domestic Co. recognizes as gross income. Domestic Co. can take a deduction against this income of $500, 50% of $1,000, under Section 250A. The remaining $500 of GILTI is taxed at a rate of 21%, for a total tax of $105. This results in an effective tax rate on GILTI of 10.5%. Earlier in this lecture, we discussed how certain difficult CFC issues, such as from the sale of digital property produced using licensed property can be rendered moot because of the GILTI rules. Here's why. In general, the Subpart F income of a CFC is taxed directly to shareholders under the rules discussed earlier. Under the CFC rules, any remaining income is not taxed to the shareholders until distributed. Under the GILTI rules, however, CFC income taxed to shareholders is not limited to Subpart F, but Subpart F income is excluded from GILTI income. In effect, in many cases, U.S. shareholders are taxed directly on most of the undistributed and not previously taxed CFC income either under the CFC or GILTI rules unless the income is specifically excluded.